are in listen-only mode.
Welcome and Happy New Year. This is the first market update for 2014 for premium account members. Any individual reading and listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hine, current Managing Director of Investor Signals, Global Equity Management and the Investment Manager for the Investor Signals Unit Trust. I have over 17 years of experience in the financial services industry as a licensed securities advisor. The format for today's presentation, we do a quick summary of the macro update or the outlook that's been driving equity markets over the last number of weeks. We roll through the ASX top 50 as an introduction to sort of summarising the general trends within the top 50 companies with a particular focus around the 2014 earnings per share outlook and dividend per share forecast, keeping in mind that we're about to move into the Australian earnings season where we'll see the results for 2013. So the focus will be on the companies that are likely to deliver the growth between the 13 numbers and 14 numbers, so over the next 12 months, and that ties in with the conclusion around our 2014 general portfolio strategy and our shorter-term Australian market outlook. The services that we provide are up on screen there, and if you'd like to know more about those, please contact me, Leon at investorsignals.com. Up on screen now is a graph of the Dow, and if you'd been following our recordings for the most part of 2013, we were obviously bullish on equity markets and saw that valuations was underpinned by low global bond yields, and we've effectively kept a long bias towards Australian equities. The US market has clearly outperformed the Australian market, and that's a reflection of their expectation of their accelerating GDP picture relative to the rest of the world, and obviously the stimulus measures that the Federal Reserve have been providing, where they've been pumping in roughly $85 billion a month in bond purchases, that money's finding its way into equity markets. The US is continuing to provide a strong recovery in the housing market, and we're seeing the employment picture continue to improve. The November employment numbers in the US were very strong. The December numbers that have just come out are actually a little bit weak, and I'll talk about that a little bit more as we move through. But some of those, the lower number in December, I think, is partly a seasonal issue and weather impacted as well, so we don't really read too much into that. From a valuation standpoint, the US market is expensive, as are most equity markets from a historical PE valuation, but given that bond yields are at such low levels, we do expect PEs to maintain at slightly higher levels. Ultimately, what we're likely to see is an accelerating global GDP picture, a slight pickup in bond yields, and equities will move higher but underperform relative to the type of increases we've seen over the last few years. So our base case is that equity markets are still well underpinned. The US should grow earnings by about 8%, so when we come back into this coming week is the beginning of the December quarter US earnings season. So over the next couple of weeks recordings, we'll drill into some of those US earnings results and really just start to confirm that the US corporations are actually growing top-line revenue as well as just meeting their profit growth through cost control, which has probably been one of the overriding thesis over the last couple of years in US corporate earnings. But generally about 8% EPS growth on a forecast basis over 2014, and we're looking for the US economy to gradually accelerate up to 3% plus from a GDP standpoint. One of the real sort of points of note here in equity markets over the past Christmas period is probably the strong move in the 10-year treasuries in the US. So we saw the Federal Reserve come out just before Christmas and flag that they're going to pull back on their stimulus or their bond buying program from $85 billion a month back to $75 billion. With the weak jobs data that came out for the December period, the market started to question whether the US will be as aggressive in winding back that stimulus as analysts first started to think sort of following the December commentary. So what we've seen is where the 10 years started to accelerate, and the importance here is obviously as the yield on these 10 years continue to rise, it has an impact on the profit margins that banks make. It means that corporate repayment of debt is more expensive, and then obviously investors start to balance the risk of being in equities versus the guaranteed yield of bonds. So in normal circumstances, we'd expect to see this back up at around 4%. So from a historical standpoint, it's still at very low levels. And I've always maintained that around 3%, I think if we see this bump sideways, I think it's an environment where equities can continue to move a little bit higher. So we'll keep an eye on that throughout the year. And then over to the Australian market, we're trading about 15 times forward earnings, just over a 4% dividend yield. We delivered very little earnings growth in 2013. Analysts are still fairly optimistic about growth in 14, delivering somewhere between sort of that around 8%, again, say 5 to 8% EPS growth plus 4% dividend yield. As we move through the top 50 stocks, I'll identify where we see value, but there's no doubt that some of these yield names are looking expensive, and we could see a year of consolidation in some of the yield names. On that note, let's jump straight into the top 50 stocks, and I'll roll through them as quickly as possible. So AGK, disappointed over the last 6 months with a guidance towards flat earnings after the market expecting that they would grow earnings somewhere closer to 10%. So for 2013 numbers coming up in February, we don't have high expectations, but commentary out of the company suggests that pricing power is starting to improve, and I think we could see forward guidance upgraded where AGK returns to sort of 5 to 8% earnings growth. At around $5.50, I think the stock starts to look expensive. If we can sell calls up at around $16, collect the upcoming dividend, collect some call premium, that's the trading range for AGK, and we have been buyers of it here at lower levels, so benefiting from that uptrend there in AGK. Asiano, we were cautious on this one at $6. We had a target of around $5.50. From our point of view, the bullish story for Asiano is that the company only pays out about 25-30% of its earnings in dividends. So there's room for management to upgrade the dividend payout ratio. The company underlying earnings should grow maybe at around 5%. So at around this 550 level, it still looks interesting, but we haven't yet really focused or shifted to a allocation in Asiano as yet. Amcor, so we finally saw at the end of the year the demerger of the Aurora, which was the Australian packaging assets of Amcor. So we're now left with essentially the faster growing global and emerging market exposure of Amcor. Has a lot of US dollar earning exposure, so if the Aussie dollar continues to remain soft, then the outlook for Amcor should remain bullish. However, on a very high PE, and now to put some numbers on it, 20 plus times earnings, trading on less than a 4% dividend yield. That's for 2013. That's in the past. Looking forward to 2014, puts the stock at about 17 times earnings, just over a 4% dividend yield. So I think we're in fair value range. In all likelihood, Amcor probably should trade no lower than $10 and really not too much higher than $11. I think we get into a protracted consolidation here for Amcor, which is fine. It creates a good strategy as a buy right where we can drive roughly 10% income from collecting the dividend and the call premium. AMP, we're not doing there at the moment. They're disappointed with earnings downgrades. We'll have a look at the 2013 numbers as they come through and check the commentary from the company in regards to 2014 outlook. Australian banking stocks continue to look solid. All the data supports to improving residential construction market and housing recovery, which should aid bank earnings. The caveat there is obviously a slightly softer employment picture, potential bad loans in the mining sector, but not to a point where it's anything significant. Probably the real issue for the bank is their loan provisioning is at historical low levels, so you're not going to get the tailwinds that we've seen over the last 2 years where they're adding. So roughly over last year, to put that into perspective, the underlying businesses grew somewhere between 3 to 5%, and there's roughly another 3% contribution to earnings through them adding back loan provisions. So again, those provisions are at a historical low level. So net from here forward, it really is about top line revenue and bottom line profit growth in order for these businesses to continue to deliver strong earnings results. I think we've probably got the backdrop, the economic backdrop for them to deliver 5% underlying EPS growth. So in ANZ case, that puts it on a forward yield into 2014 of about 5.5%. So I think the range for the banks is maybe sort of from where they are at the moment up to maybe a maximum of 10% higher, but largely we'd expect ANZ to trade sort of between this $31 range and maybe up to as high as sort of $34 over the coming months. I'm not doing there in ASX, so to put some numbers around this, on forward 14 earnings, trading about 18 times earnings on a 5% dividend yield. We saw the December trading volumes were very strong, which was probably an unexpected surprise to see volumes up about 10% on the same time last year. We're seeing a fair bit of activity in the merger acquisition side of global exchanges, and I think that's helping to add a premium to ASX. Underlying earnings in general for 13 will be flat. Out to 14, I think we're starting to see slightly better market conditions, and I think ASX could grow sort of 5% earnings. But this is another one of those names where we own it at lower levels. Up here it starts to get a little bit expensive. If we can sell covered calls up at around the $38 level, I think that sort of more than caps the upside potential there in ASX. AZJ, we've been recent buyers of it on the pullback here at around $5. The stock starts to look full value. However, into 2014, maybe into the back half of 2014, I could see AZJ holding $5 as the new support level. The stock is expensive from a PE standpoint, over 20 times earnings and delivering around about a 3% dividend yield. But I think the growth in the underlying business is certainly delivering double-digit earnings growth. Again, I think it moves into a trading range of sort of 5 to 5.50 by the second half of 2014. BHP should deliver around 15% EPS growth, trading at about 13 times 2013 earnings, about 12 times 2014 earnings. The stock's currently on just under around a 3.5% dividend yield. We've seen the iron ore prices soften a little in the back half of last week, but ultimately I think sort of BHP should hold sort of at around $35 support and ultimately trade back up towards $39, $40 over the course of 2014. Brambles. So we've seen the spin-off of the recall assets, a little bit like Amcor. It now leaves the stock on a fairly high multiple. I have Brambles trading at about 19 times 13 earnings, and if we look at it into 2014 and allow for about 8% earnings growth, the stock's still trading at about 18 times earnings on a 3.5% dividend yield. So whilst I think the downside risks are limited, Brambles is obviously a US dollar earner, so it'll benefit from a low Aussie dollar. I really think we're in a range where at best it just tracks sideways, so it definitely becomes an income strategy for 2014 where we want to own this name still, sell the covered calls, collect the dividends, and we're going to drive around 10 to 12% cash flow out of Brambles over 2014. CBA, same thing, 5% EPS growth, probably on a slightly lower dividend yield than some of the other banks, getting down to just sub 5%. First to pay its dividends are coming up in, I think, late January, early February. CBA pay their div, whereas the other banks are obviously not paying until May, so I'd expect to see CBA reasonably well supported just from a dividend rotation standpoint. Coca-Cola, we own this. We've been accumulating it again down here at lower levels. We have the stock trading at about 5.25% dividend yield, trading at around 15 times forward earnings into 2014. The company has already sort of reduced market expectations and suggested that they'll have flat earnings in 2013. I don't see that Coca-Cola will do too much more than maybe push back up to around $12.40, $12.50 at the most, and at that stage we'd look to sell covered calls and strip the dividend out in the call premium around the Coca-Cola trade. I think on a forward outlook over the next 2 or 3 years we could see Coca-Cola maybe pick earnings back up to around 5% growth as long as management come out with some a new strategy around cost control initiatives. Computer shares getting a little bit expensive up here. This has been one of the beneficiaries of the Aussie dollar play. and exposure to the US recovery in corporate activity, IPOs and mergers and so forth. So we have Computershare trading at about 19 times earnings, and that's into 2014, and just under a 3% dividend yield. So the company should probably grow earnings somewhere close to, high single to low double digits, so somewhere around that 8 to 12% EPS growth. This will be one we'll watch in earnings season with a great deal of interest. But we have owned it at lower levels, and we've largely taken profit now up at or near these price points. CSL, so again, beneficiary of the low Aussie dollar. The company should grow earnings about 10%, trading on expensive PE up at about 22 times earnings. The company's still concluding I think another $900 million of share buyback throughout this year, so it should help to underpin the price expected to bounce sideways. Crown, a lot of analysts are starting to upgrade their earnings around Crown, looking for around 15 to 20% earnings growth in 2014. The stock trades on a reasonably high PE, up at around 22 times forward earnings and just over around a 2.5% dividend yield. Dexus, we've seen Dexus and GPT bidding for Commonwealth Property Office Trust, and in the end common sense prevailed, and we've seen them rather than compete at a price level and drive up the bidding process for that acquisition to a point where it was not commercial, we've seen Dexus and GPT agree on a split up of the Commonwealth property assets. And I'll chat a bit more about that when I get to GPT, as our preference is GPT over Dexus. Fortescue not doing there at the moment, although I had warned at the end of last year that around this 575 was starting to get a little bit expensive. Fox, interesting that Murdoch's come out ahead of time and announced that they're going to be delisting Fox from the Australian market, so it will become in 2014 a US listed business only. And so we do own it at lower levels. We've sold the $39 calls into around March, April. So the stock is delivering a good income. I would expect this sell-off as portfolios in Australia get out of the stock, as some fund managers can't hold US dollar or US assets in certain investment mandates. So we'll continue to review that throughout the early part of 2014. But certainly the Fox business is performing well, growing at around 8 to 10%. Goodman Group, as expected, once it got down around a 5% yield, it was well supported. I don't think the property REITs are going to do a great deal unless we see the 10-year treasuries in the US really start to pull back from 3 back to maybe 2.5. Then we'll see another rally in the REITs. Otherwise, the REITs are likely just to bounce sideways over the next 6 months. GPT, we were buyers of it at lower levels here. We've seen them, as I said, split up the Commonwealth property office assets. GPT's taken about $1.2 billion of that portfolio. Dexus is taking the rest. I think here at around a 5.5% dividend yield, GPT's well supported. Could push up to around 390, but that's the resistance. I think it largely trades sideways, should deliver about 4 to 7% earnings growth. IAG not doing there at present, nor in Iluka. IPL, so we've been patient here. We haven't sold the covered calls. We've been waiting for this rally to get underway. I think there'll be a little bit of short covering in IPL. What's driving this is we're seeing an improvement in DAP prices. So fertiliser prices are starting to move higher after 12 or 18 months of them trending lower. At around $3, we would consider running a covered call strategy over IPL, but looking for a little bit more out of that. Lendlease should deliver about 5% earnings growth into 2014, trading on just over a 5% or just almost a 5% dividend yield, about 4.5% dividend yield. Our range here is really from maybe $10.50 up to around $12. Wouldn't see it doing too much above $12. However, what is worth noting here with Lendlease's management has made a pretty bullish outlook over the next 3 years that they expect earnings to return back to double-digit growth. So in that environment, if we were to see that over the next 2 to 3 years, feasibly Lendlease could be trading back up in a range of $12 to $14 over the next few years. So we continue to like exposure to Lendlease. MGR, we're not in this at the moment, but generally the Australian property plays are starting to perform well off the back of the better data around the housing market here in Australia and unit sales. So from Mirvac's standpoint, about 5% underlying earnings growth. The stock's trending back up towards a 5.5% dividend yield. Not doing there in Macquarie. So NAB, we continue to like that, and we poured money back into NAB and ANZ at the end of last year in middle December or late December, and we're looking for the banks to push a little bit higher before we get calls away on those. NAB should deliver about 5% earnings growth. In 2014, we've got the stock on just over a 5% dividend yield at the moment. Newcrest Mining not doing there at the moment, but good to see a recovery, albeit a very small one in context of how large the fall's been. But gradually, over the next 2 to 3 years, we do expect to see Newcrest perform much better than certainly what it has done. Origin expensive up here at about 19 times earnings and a 4% dividend yield. Our range has really been from 14 to 15. We have been buyers of it on this dip, and we're looking to sell calls up at around the $15 to $15.50 level over Origin. I think from 2015 through to 2018, I think Origin will be substantially higher than where it is at the moment. I could see Origin back up at around $17, $18, but over the next 6 to 12 months, I think at around sort of $15 pulls up the resistance there in Origin. Skipping through a few names here into Rio. So we had, for clients that did own Rio, we'd sold the calls up at around $68. Driving some income out of Rio. Should deliver earnings around 10 to 15% growth, but obviously quite dependent on the iron ore prices. Stockland, so this is one of our favourite sort of property plays here. We've been buyers of it at lower levels. We've collected income off the covered calls. We've collected the dividend at the end of December there. I think the stock starts to perform at around $4. It looks pretty full value for us. Should deliver around 4 to 6% earnings growth and trading on a dividend yield of around 6% at the current levels. Not doing there in Sonic. I will flag that we were looking for it to pull back down to around $14.50 to $15 where we thought it was good value. It spiked down there, but the rally took off pretty quick soon after. Santos, I'll cover more about the oil and gas stocks in next week's recording. And just skipping through a couple, so Transurban. So what we're seeing in some of these defensive yield names is as those treasuries in the US started to accelerate, we've seen the defensive yield names come off their highs a little. If what we've seen in Friday's trading, where the weak US employment data has seen the market strip out some of the prospect of a reduction in Fed stimulus, then we could start to see these defensive yield names just tick higher over the next few weeks, in which case we'd use that as an opportunity to sell the covered calls, again driving sort of around 10 to 12% cash flow out of something like Transurban as a result of that covered call strategy. Telstra, so interesting play here with Telstra. With the improvement in the IPO market, we're starting to see Telstra divest of some of its non-core assets. They're certainly trying to refocus the business on faster growing sort of cloud computing, IT and mobile, and I think ultimately that will probably deliver where we've seen Telstra have a fairly benign underlying earnings growth. We could get into an environment over the next 5 years to 10 years where Telstra actually starts to deliver higher single-digit earnings growth. Right at the moment, though, over the next 12 months, it's still a yield play at 5.5% dividend yield here. Yes, it could compress down to, say, low 4 as a dividend yield, so it does have the capacity to trade probably up to around 5.50 throughout 2014. So we continue to like Telstra and continue to revisit that as an exposure in portfolios. Toll, flat earnings in 2013, not expecting too much of a change in 14. Our range really here has been to own it at low 5s and sell it up at $6. Up at $6, the stock's delivering less than a 5% dividend yield, and with very little earnings growth, I don't think it supports a higher price than that range we've indicated there. Westpac, same with the other banks. So Westpac's a name that we like. I think it could push maybe up to around $34 over the next 6 months. And our strategy is to sort of own it at these levels, sell the covered calls, make sure they're European, and collect the May dividend in some of these banking names. WDC down here at around a 5% dividend yield should find support. I think the new range over the next 12 months is probably $11 $10 up to around $11. Any push up to around 10.80, we'd use that as an opportunity to sell the covered calls up at around 11.40 or 11.20. On Westfield. Wesfarmers are expensive from a PE standpoint, should grow earnings at around sort of 8%. To put some numbers on that, I've got Wesfarmers trading at about 19-20 times earnings on about a 4.5% dividend yield. So at $44, I think the stock looks expensive, maybe could trade 45, but certainly throughout over the next 6 months, any opportunity to buy Wes on a dip, we continue to like the Wesfarmers story. As is the case with Woolworths, as a defensive yield play, the stock's compressing down to around a 4% dividend yield, trading at about 16-17 times 2014 earnings. Woolworths should deliver somewhere between 4 to 8% earnings growth, and we do own it on these pullbacks. As it rallies a little bit higher, we look to sell the covered calls up at around $35, $36. They'll be European, so we'll collect the upcoming dividend and collect the call premium, plus have the opportunity for some capital growth. So I'll summarise those as I conclude with the portfolio strategy for 2014. Woodside Petroleum and BHP still remain our preferred resource exposures. Woodside Petroleum at this level is yielding around 5.5–6%. They should deliver around 5 to 10% earnings growth. At around $40, I see the stock as full value, but it's a name that I'd expect to bump sideways through the most part of 2014 at or near these levels. Westfield Retail, down here the stock was yielding around 6.5%. We're seeing push back up to around 5.5%. We're not looking for a lot of earnings growth. Obviously in 2014 we'll see WDC demerge its Australasian property assets, and they will be acquired by WRT. So we'll see a larger WRT emerge throughout 2014. I don't think from when we've looked at the numbers it substantially changes the earning picture from a growth perspective. So as long as it really just becomes a yield story where any pushback up to around 315, we would take that as an opportunity to sell the 320 calls into the year end. And that's it for a quick roll through the top 50. Just to summarise the strategy for 2014, some of these US dollar earners are still attractive, albeit they're on high PEs and the yields have compressed down. So we're buyers of them on a pullback on some of the selected names that we still have exposure to in the US dollar earners. We're selling tight covered calls. Certainly Woolworths, Wesfarmers, Coca-Cola. We like those names from a defensive income standpoint, and from a growth perspective, a little bit of origin in portfolios. BHP, Woodside Petroleum are some of the names that we're drawn to, but generally we see 2014 as a year where equity markets are well underpinned by the low global bond yields and central bank policy. We should start to see better growth contributed to the global GDP picture from Europe, and I think we are in an environment where equity markets move higher. Analysts forecast for around 5 to 8% EPS growth, I think should be achievable, and we probably finish the year on slightly higher levels than where we are today, and we look to sort of benefit from running the tight covered call strategy across portfolios to drive that higher cash flow out of some of these defensive assets. Thank you for listening in, and I look forward to speaking again next week. And I display our phone number up on screen there if you would like to discuss any aspect of today's recording or the market in general. Feel free to contact me on 0292388188 or email leon@investorsignals.com.